Hi everyone, and welcome to our macro break webinar. So it is the first this year, the place where we are sharing updates about the latest news in economics, finance, and investments. And thanks for joining here today. As you know, this webinar is hosted by Quantilia, the data management and analytics platform dedicated to wealth managers and institutional investors. So today is really a big event, and I would leave the word directly to our speakers, and firstly to Jay Pelosky. So Jay, thank you very much for being here today to share this great day. So I leave it to you, the word.
Thank you. Thank you, Katerina. And let's see, good morning, good afternoon, and good evening. This is truly a tripolar world event. I'm so excited to be a part of it with two of my good friends in the investment business and two people who I admire greatly for their investment acumen. And what I think we can do today is bring three of us, each independent, each deeply experienced, and each in a different part of the world to talk about the great rotations of 2021. I'm going to introduce each of our three panelists very quickly. I'll note that their bios are available on the invitation. So I'll start with Ching in Shanghai. Ching and I met probably 15 years ago on one of my research visits to China. She is one of the most experienced equity managers in China. She has a growth focus, and she is a go-to investor for many of the world's largest sovereign wealth funds and pension funds. She also does a great job sharing photographs on LinkedIn. So I encourage you to check out her photos, if nothing else. Jacques in Geneva is a more recent friend. He recently launched Gate Advisory after several decades in the investment business in Europe. And I was so impressed by what I saw that I reached out to him immediately and started a dialogue. And we've become good friends and kind of simpatico as how we think about the markets. And Jacques is a forward thinker, focused on quantamental, trying to take advantage of technology and marrying it to his fundamental outlook on markets, a global macro point of view that I think is very differentiated. And finally, myself, Jay Pelosky, here in New York City, founder of TPW Advisory. We're an independent investment advisory firm, a boutique here in New York, focused on global asset allocation and portfolio strategy and ETF-based model delivery. I have 30+ years of experience in the markets in over 50 countries and have developed the thesis, the tripolar world. So all three of us together are going to give you our best insights in kind of a rapid fashion. We'd like to keep it moving. So here's kind of the ground rules. We're going to focus on the three topics: why China, the rise of thematics, and inflation matters. Each of us are going to have 2 to 3 minutes to speak on each topic, and we're going to go twice on each topic. Then hopefully that's 3 topics, roughly 15 minutes, so 45, 50 minutes, hopefully 10 minutes at the end for questions. You can put your questions up at any point, but we will address them towards the end of our hour together. So before we start, I'm going to ask each of the three of us what the term great rotations means to each of us. And let's keep it short, and then we'll get into the topic. So Jacques, to you first, what does the term great rotations mean to you?
I will try to define that with 2 quotes. Okay, the first, the two are coming from former economists. One quote is: "The old world is dying, and the new world struggles to be born. Now is a time of monsters." Definitely, it's what is happened now. The second quote, it's from an American economist, is anyone who believes that exceptional growth can go forever in the finite world is either a madman or an economist. I think that we are at the tipping point of a huge transformation of our societies, our economies, our financial markets, or even the planet. Okay, and I think the COVID just accelerate the current balances in societies and economies. And we are living in societies where we are wanting or thinking to control the economy with central banks interventions. We think or we believe that we're controlling societies with social networks and populism, or even controlling death with research in DNA on augmented human technologies. But unfortunately for these brain plants, a virus is just there. It is always continuing his own evolution, free of any dictates of humans. Now we are in a major tipping point of massive rotations. Back to the market, to finish my point, dispersion trades reach new highs in demonstrating that rotations are engaged. And we will see in the further points what means rotations.
Perfect. Thank you. Ching, what does rotations mean to you?
Very simple. Buy China.
Awesome.
That's it.
Awesome.
That's it. Okay. All right. I'm not ready. I thought you were going to take another minute or two.
No. I'm only allowed to 1 second. So buy China.
Okay. Buy China. Okay. Well, I think it's interesting because to me, I think one of the great rotations is the rotation here in the United States of moving away from a 40-year regime where it was argued that government is bad. And I remember Ronald Reagan in the early 1980s said the 9 most terrifying words in the English language is, I'm from the government and I'm here to help.
That's right.
And that has been the guiding ideology in the United States for literally the last 40 years. And I think we're in the process of changing that to where government activism is good. And we see activist governments, not only in the United States, but in Europe and in Asia as well. And activist governments lead to kind of policy-driven markets, which set up the opportunity set for thematic investing. And so I think there's significant rotations, kind of to Jacques' point, significant rotations within markets, across markets, even the idea of rotating away from what's been an excellent strategy for the last decade, the 60-40 strategy, which in the United States returned 10% plus per annum. I think going forward, that's going to be very, very difficult to attain. And so we're going to need, again, to Jacques' point, we're going to need to have much more dispersion in kind of our way of thinking. And Ching set us up perfectly by saying just buy China and you're all set.
I mean,
so that's a perfect lead-in to the question, why China? And so Ching, you go first, and then we're going to, I'm going to go second, and then Jacques will go third. And let's remember 2 minutes, please, and then we'll go around twice. So Ching, why China?
Sure, why China? Well, actually, you mentioned this 40 years. You know, I want to borrow this 40 years just to talk about my personal experience. You know, 40 years for me, I have witnessed China to coming out of poverty, and forget about what has happened during this process of it, but just let's focus on 2020, COVID. I think the world has seen the execution capabilities of Chinese government. And I think the world has seen what does it mean to respect law and orders out of 1.4 billion people. That's one of the reasons I say buy China. So I now used up 20 seconds already of my time. I think I'll just give you a few statistics about China. You know, if you look at China GDPs coming out of last week's number, China's GDPs has reached 15,000 billion US dollars in 2020. And GDP per capita has reached 20,000 for the whole nation, 1.4 billion people. And this number is compared with the US. Look at US. US reached a GDP per capita 1913. I believe Germany reached GDP per capita in 1959. Japan reached GDP per capita 1960. South Korea reached GDP per capita of 1996, and even our Hong Kong reached GDP per capita of 1976. But forget about the years, forget about the 40 years, we reached GDP per capita for 10,000 only this year, only last year, but this is behind 1.4 billion people. So it's a huge market. So that's number one by China. The second, government is putting a very strong support for the new growth areas. And we look at past 20 years, you know, from year of 2000, it's the first 10 years, it's the trade, you know, China joined WTO and benefited greatly from the trade. And the second 10 years, you know, right after the financial crisis, you know, 2020 to 2010 to 2020, where the internet as reason that China has benefited. And in between, you know, government has been using a property-driven and infrastructure-driven sort of stimulus to push the economy. And then they realize it actually, they need some new method to coming out of this asset-heavy growth. And what is it? I think the government, it's really pushing the Chinese economy from property-driven and infrastructure-driven into innovative-driven, consumer-driven, and market-driven. You know, so we have this internal, we call it internal circulation. I mean, it sounds not so nice, but it's really about domestic demand, domestic output, domestic supply chain, and domestic innovation of technology. So I think, I mean, I have many more reasons, you know, to talk and lots of numbers to support, but also China has entered into a new era of asset reallocation, you know, with wealth moving into capital markets. Last week, we have single mutual fund that attracted 200 billion in 2 hours, you know, with 7%, 2 hours, 7% allocation for those investors. I mean, I think this is record. You know, we also have funds coming from Hong Kong. We call it the southbound, that buying up China A shares, only A shares, not H shares, not ADRs, buying up $5 billion US in one day, highest ever that happens in history. I think. Okay,
Ching, thank you. Well, why don't we stop there and we'll come back. You'll get another chance to talk about why China again. But wow, those numbers certainly for asset managers, it suggests that the idea of cutting off China is highly unlikely to be successful. Let me take a couple minutes to give you my view on why China, and I'm going to pull out a little bit and talk about Asia more broadly, because my way of thinking about the world is what I call the tripolar world of each of the three main regions, Asia, Europe, and the Americas, kind of integrating more rapidly as the operative outlook for the global economy. And when I think about Asia, I think about really two things right now. One is kind of the rapid integration, whether it's through things like the Belt and Road Initiative or the recent signing of the RCEP the Regional Comprehensive Economic Partnership, which kind of binds ASEAN to China, Japan, and South Korea, really driving regional supply chains and regional integration, as well as the second thing I think of when I think of Asia is growth and consumption. And Ching mentioned the internal circulation strategy. I think that's going to be an important driver to China's rise going forward, as she suggested. The second thing that I think about is how Asia was really the first in and first out of COVID, and really what that means, the leverage that supplies Asia in terms of already growing and recovering. Certainly China, the only major economy to grow last year, but not more importantly, but also very interesting, is the growth of trade within Asia. Just to give you a couple of numbers, in December, Taiwan's exports were up 40% year on year, 40%. Japan had its first year-over-year export growth in over 2 years in December. And in South Korea, the first 20 days of this year, 2021, exports were up over 10% year over year. So part of this is the semiconductor supply chain, which we all know, the semiconductor shortages now affecting auto plants around the world. That suggests this kind of demand is going to continue for a period of time, certainly through the rest of this year. And then the third point, and then I'll stop, is the strong renminbi. I'm a believer that we're starting to see the outlines of regional currency blocks, the renminbi in Asia, the euro, and the dollar. I think we can maybe talk about digital coins, which China is looking at, the ECB is looking at. I'm sure we'll see something in the United States over time. But to me, a strong renminbi is very interesting because one, it supports this internal consumption idea in China. Two, it provides an umbrella for the rest of Asia to compete underneath China. And three, it's inflationary for the broader world, which is something we clearly need. China is still the price setter for manufacturing goods. And if their price is effectively going up with a stronger currency, that's bullish for the rest of the world. And that's clearly something we need as we try to recover from the sudden stop of last year with COVID. So I'll stop there. Those are just some quick thoughts. And Jacques, over to you.
Thank you, Jay. I will be brief because you cover plenty of aspects. I will mention just one thing. So you know I love history. On one of my favorite books is The Art of War, written by Sun Tzu. And in the same period, an Athenian historian and general, Thucydides, just put some base in principle, just demonstrating that the apparent tendency towards war or conflicts when an emerging power threatens to displace an existing great power as an international hegemony. Meaning that during the history, we saw Portugal versus Spain, France versus England, UK versus US, USA versus USSR, and so on. But when a leading nation or city just was challenged by the second, always tensions occur. Not always wars, but always tension. It's explaining, I really want to point out that because it's explaining why the place of China now will not be reached as the first major country in the world in terms of every metrics without any tensions. It's normal, but we have to manage that in asset allocation, and we need to assess that in the investment process. The second point for me is the visibility. Why China is interesting. I call this, and we shared together, Jay, during a previous conversation, is the verticalization. Verticalization meaning the alignment of interest between the state on corporates. There is only 2 areas with numerous number of people using this kind of tool, okay, because it's working on both ways. It's USA and China. It's very important because as an investors, we can be sure that we have visibility or coming from the corporate or coming from the states with a coherent alignment of interest to increase the growth, GDP growth, or to improve the employment. I am European, trust me, it's not the case in Europe at all. That's why I think that in terms of asset allocation, China needs to have a huge place in the asset allocation. And I will finish by my last point. It's that Xi Jinping or the previous president just tried to double the GDP. That in some decades they succeed in that. They now want to expand also to double again the GDP, and I'm quite sure they will succeed. But in terms of temporality, okay, we are all in the Occident running over the 4 years or 5 years mandate, okay? With Xi Jinping, he has time, okay? And mainly now with the last Politburo, he just put in place a 50-year plan, not only a 5-year plan, but a 15-year plan with inside 3 5-year plan, meaning that is strengthening the vision of the Politburo or all the Made in China 2025 or China Decarbonization 2060, for example. Or for an investor, it's key to have this kind of vision.
Thank you. Ching, do you want to have another 2 minutes or so to finish out your thoughts on China before we move on to thematics?
Yeah, no, I think you talked about currencies, you know. I think China's currency has been quite stable. I wouldn't call it strong. I mean, they appreciated about 7-8% last year. And I think the important thing is that, you know, one of the factors that people started to look at China in a more aggressive way is the stability of the currency. And what is the currency behind? I think is the trust. When you have kind of trust, then you want to allocate more assets, whether it's in private equity or listed companies like what we do, or some properties. So the currency behind it is a trust, and I hope Chinese government and trust would build up over very long period of time. And I simply don't think Chinese currency would become reserve currencies very, very soon. You know, I cannot see it in the next 3-5 years, but, you know, 7-10 years. And so I hope Chinese government will continue to build up that trust. And also the good thing of having a stable currency is that people are, like international investors, it makes your guys much more easy to speed up your allocations, you know, asset allocations into China. So that's another important factor, and a great rotation. That's why I say why China, and it's this is one of the elements of that as well.
Perfect. Ching, can I just ask you, I'll take advantage of being the moderator and ask you very quickly, in terms of the currency, does this mean that you think the internationalization or the opening up of the currency capital controls is going to happen in China? In other words, there's a lot of focus right now on money going in, which is fine, makes sense. But what about money coming out in the Chinese investors having the opportunity to kind of diversify their financial asset portfolios?
Sure, yeah, that's a very good question. I think the Chinese government did a very good job in sort of pushing or guiding the international money flowing into China through the Connect, through QFII, through other channels as well. And at the same time, the government has opened up for the Chinese residents to be basically able to buy Hong Kong listed shares, that has been happening for 3 years. They've been pushing for ASEAN countries to use RMB as a settlement, and also signed a great accord with the European countries. I think I know that there are intentions that the government wants to allow corporate individuals and pension funds to be access to international equity market, where US is probably the biggest one. Due to the strain of the relationship in the past 4 years, I think that process has been slowed, but I'm absolutely sure that this is in the back of the mind of the Chinese government. I hope it's in the back of mind of the US as well. So you will see two ways in the next 3 to 5 years, and two-way flows, and not just a one-way.
Awesome. That's great. That's very good to hear.
Yes.
Good. I'm going to go ahead and suggest, Jacques, that you and I hold on our second round of thoughts on China and move to thematic, because I see it's already 7:30, 7:29 here in New York. So I'm going to start off on the thematic and then go to Jacques and then to Ching. And to me, this is really a key issue, at least for the next 1 to 2 years. Why thematic investing? To me, it really goes back to what I've been calling COVID speed. If you think about the last year now, effectively, COVID speed, the speed of the spread, the speed of the policy response, the speed of the market reaction to that policy response, the speed of the science in developing a vaccine in 1/10 of the time that traditionally it is taken to develop a vaccine. And now, hopefully, the speed of delivery, which is not quite as fast as we would like it, but I think is clearly going to pick up here in the United States, and I imagine in Europe as well. And so to me, we've seen kind of proof of concept of what you can do when you have global, cheap, and abundant capital, financial capital, put together with global intellectual capital focused on a single issue. That is the new model, and the market has seen that and is now looking at shifting COVID speed, or I say that COVID speed is breaking out beyond health to first climate. If you think about what else is out there that's big and global and has a lot of attention focused on it, a lot of science and technology attention focused on it, clearly climate is the second issue. And then third, you can think about things like cyber. And then in addition, fintech and crypto, as well as, of course, the traditional idea of innovation and disruption around manufacturing, around production, which is in itself a significant theme. So when you think about climate, for example, in the last 6 months, we've had roughly 70% of the world's GDP commit to net zero by 2050. And the changes that are going to have to take place in order for that to actually occur are dramatic. And I think this explains a lot of what people are calling bubbles in the marketplace, is really an imbalance between the amount of capital that wants to participate in this and the number of vehicles available to participate. If you think of Tesla, if you think of clean energy, if you think of charging stations, there aren't enough vehicles or instruments for investors to participate. And so I expect to see a significant increase in IPO activity as we saw last year. I'll give you one statistic. There are 500 unicorns around the world, tech companies that have $1 billion or more valuation. There are now 500 of them. Whereas when that term unicorn was first mentioned financially, there were only 50 10 years ago. So to me, we're in a less generous beta world where, as I mentioned, the 60-40 idea is not going to return 10%. Alpha generation, I believe, will come about through thematic investing. And to me, that's why thematics are so critical to investors. The question is how much, not how much you have in stocks or bonds or China or the US or Europe. It's in part, how much do you have in these different thematics? Jacques?
I'm fully agree, Jay, on, you know, it's in Get Advisory, it's just one of the pillars of our services thematic. I started thematic in 2012 with Chinese thematics. For me, thematic just help clients to understand the purpose or the why of investment. Many millennials now are focusing on people need to understand or want to understand why they invest in something. If you mention just, okay, buy European equity, okay, why I have to buy, on what I have to buy in Europe to just overperform indices, because now millennials are playing with ETFs very easily. If we want to be different, or if you want to extract value on alpha from any investment classes or countries or region, we need to address thematic, I think so. I put just one number. I know that this is one of the most famous thematic around the world is the ESG, okay? But it's kind of symbol, okay, of the rise of the thematic. An American foundation named SIF just produced his annual report 2020. In this report, they just put two numbers, okay? The investments on sustainable investing assets now total $17.1 trillion, or 33% of a total of 51.4 trillion in asset under management in investment fund. This is plus 42% compared to 2018, according to Market Watch report. This is now investors or many clients, from private clients to institutionals now, are ruling their asset allocation not with the previous asset 60-40, as you mentioned, but more with a core satellite. In the satellite, more and more thematic are taking a huge place, or they demonstrate a huge overperformance over years. As you mentioned, there is plenty of thematic now. Many China produce two main thematic. On one is my favorite one. It's China Decarbonization 2060. We are the first, perhaps, to produce this kind of thematic on fund. Honestly, we are thematic everywhere, even in Europe. For me, is not a no-go zone in terms of investment, but I think I would prefer US on China first. I think that thematic is very interesting to extract some value from some area, from some sectors. As you mentioned, there is the digitalization is ramping up everywhere, meaning that new sectors are arriving, new technology, new commodities too. I think we could extract different values through thematics to be agnostic in terms of asset classes. We can grab thematic in commos, in currencies, in equities, of course. I think that it's a good way to think, to rethink the investments. If you want to be more, to understand, if clients or investors understand the why in investments, they understand the risk. You cannot understand the risk if you don't understand the why. On my side, it's just my view.
Perfect. Thank you very much. Ching, what does thematics mean to you in terms of thinking about China?
I actually have very little to offer in terms of thematic. I hate thematic myself as a China manager. And I believe if we go on thematic, we basically hand over the initiation of our research to somebody else, basically chasing different styles. So I don't like it. But I understand why international investor needs to own a different asset class. So that's a different story. For me, the way to win is to be excellent at one discipline, at one strategy, and we are growth managers. We basically buy quality growth, we buy strong moat, we buy consistent earning, and we buy great management. For me, for what I do, I don't go thematic.
So that's perfectly fine and excellent. That clarity and that conviction is impressive. When China is marketed to outside investors, oftentimes you hear about China technology, like a K-Web, or China Health, or China, China clean energy or climate. How does that have an impact on you at all when you are looking for growth companies? Do you see situations where all of a sudden a company is part of a ETF in the US or Europe, and all of a sudden the interest just goes up dramatically and it gets pushed out of your price range? Or does it not? Does a K-Web or something equivalent in the health sector, does it have any impact on you at all?
Yeah, so for what we do, we focus mainly on 4 sectors. The consumer sectors, which is a very big sector. You have consumer staples, consumer discretionaries, and then the next one is healthcare, and that's no brainer, it has to be invested. And then TMTs, and then non-bank financials. So those 4 areas really we see high growth areas, and we define it, growth. We used to define growth as 3 different growths, stable growth, disruptive growth, and cyclical growth. I actually dropped cyclical growth because I don't like thematics. I don't like chasing different. You chase something, what you get is probably one-time revaluation. Then you have to think when to sell it. I'm not good at selling it. When I buy it, I want to buy it for my grandkids, for our clients' grandchildren as well. So, valuation, you also brought in valuation. Valuation is a different story. Valuation, as a growth manager, we are less sensitive about valuations, unless you can explain why those, Google, Facebook, and all of that, big 4, 5, Microsoft, are overpriced. You cannot talk about it, whether it's expensive or cheap. You have to explain why they're overpriced, right? So there's many reasons explained why those companies, similar things to Chinese companies we buy, why are they overpriced? There's many reasons. They have a great management. They have a consistent earnings growth. They are, they're huge ESG respect, and of all of that. And they have a beautiful balance sheet. They're not just talking about what, you cannot just look at PEs. PE is not good at good indicators for growth. Not for China growth, for all of the growth companies in the world. You have to look at a basket of indicators that to enable us to understand those growth companies.
Excellent. Well, one of the things that hopefully the audience appreciates is that by having 3 of us, each independent, each deeply convinced of how they think about the world and has spent a lot of time developing it, that you get that kind of insight and that kind of perspective, as Ching just gave you, about her view on thematics in China. That was just really great. And you don't get that from a big firm that everybody has to kind of agree before they present their public face. So hopefully you appreciate that. I know I do, and I know Jacques does. So Jacques, over to you to talk about inflation. I see we have a couple of questions, so I want to make sure we have time. So this is our 3rd and last topic, inflation matters. We're each going to go around and give our view on it, and then we're going to make sure we have 10 minutes or so to address some of the questions that are popping up. So if others have questions, please put them in now. And Jacques, inflation matters.
Yeah.
Why?
Go. For me, inflation is one of the main pillars of my outlook for 2021 with China. I am agree with many of the consensus. Okay, we are still the three main deflationary forces are still there. Okay, aging population, Uberization, and robotization. I'm fine with that. Okay, no problem. But now we have, I should say, 5 main topics now on they are new. It's the disruptions of the supply chain, thanks to Trump. He already started the job in 2018. Okay, it was not definitely a bad thing for China, but it's another topic. After we have, of course, during 20 years, okay, when China just came in the trade organization in 2000, sorry, during 20 years, okay, US global multinational just spend money, a lot of attention to optimize their global supply chain. If you put a little perturbation in the force, I should say, I love Star Wars, that's one. You have, of course, an increasing in prices. The second is the nationalism on reindustrialization, meaning that if countries start to want to reindustrialize, of course, you have less actors in the sectors, meaning that they have less pricing power to purchase more goods or services. And of course, clients will have less choice because only 2 or 3 suppliers versus 20 or 30. The third point is the rising commodity prices due to new tech meaning new needs in new commodities like rare earths, for example. Okay, the climate changes too have already an impact in commodities. The fourth point is I call this the syntax error in the calculation of inflation. Okay, of course, central banks are not computing properly the inflation. They are forgetting plenty of costs of living, like student cost, healthcare, on real estate. Okay, on the fifth is the impact of the ESG thematic. Why I put this on? It's a discussion that we have together because the ESG now, if a company wants to have a better ranking, they need to comply to ESG rules. On ESG rules, meaning that extra cost, no lower cost. On all these kind of topics together, I think it's just paving the way for an increasing of the inflations. On the top of the top, it's mainly in US, because in Europe, we are not seeing inflation, but in US, the aggregate M2 aggregate is record high. Velocity of M2 is record low. If Biden succeeds to put money, of course, directly to the household, the velocity goes wrapping up massively with the huge amount of liquidity already parked in the system. We could have kind of huge implosion of inflations on usually uncontrolled. Not for example, not for a long time of period, but even for a short time, it could challenge the central bank policies.
Excellent. Thank you, Jacques. Ching, inflation, does it matter in China? Does it matter to you?
I think it's the topic of inflation is such a nonsense. You know, it's people are so obsessed with it. But look at Japan. You know, look at Japan for 30 years. They've been printing money like hell. They have the highest debt of the developed countries. Where is the inflation? I was working in Japan for Barings from 1989 and for 1991. You know, I think, and I brought my kids back last year to visit Tokyo and to go back to see where I lived, where I worked for the same amount of money, 10,000 Japanese yen, we buy exactly the same thing. Where is the inflation? There's no inflation, you know, and they have been printing money like hell. I think inflation means buy equities, buy great assets, buy good assets, don't go cyclical, don't thematic, buy great growth. And we spend too much money about inflation. It doesn't matter. It doesn't matter whether it's in China. It doesn't matter whether it's in the rest of the world. Just look at Japan. Think of Japan. Don't worry about inflation. And I think a lot of people would disagree with me. Last year I read a very good book on John Maynard Keynes, the greatest economist. And he was the advocate of printing money. But if he had known how much his grandchildren's generation is printing out so much money, he would be turning upside down in his graveyards. So I think the history will be rewritten. Whoever is going to write about inflation 10, 20, 30, 50 years, 100 years down the line, and they're going to say inflation doesn't matter, spend your time and your energy on picking the greatest assets. Don't worry about inflation.
I'm going to have to rethink my entire approach after this conversation. Ching, that's awesome. I'm going to disagree with you slightly and wrap up.
Well, we are here to disagree with everyone.
Absolutely.
We
are agree to not be agree.
Yes, exactly. Again, what did I say at the beginning, right? 3 experienced, independent voices. Fantastic.
Independent, yeah.
Okay,
we speak 3 different languages.
I'm just going to wrap up my thoughts on this before we get to questions very quickly. And to me, the issue of inflation is interesting in the near term, because where I think the consensus is the most wrong, I'm sure like many of you, we all read lots of 2021 outlooks. And in the United States, the consensus for the 10-year Treasury at the end of 2021 is 1.2 or 1.3%, the 10-year Treasury rate. I think that's going to be completely wrong. It is going to be much closer to 1.75 or 2%. Yeah. And I think this idea that the Fed is going to taper and address and kind of cap the yield at the long end is completely wrong. The Fed has told us, as the ECB has, that it wants to let inflation run hot above target, this asymmetric inflation targeting, AIT. They want to let inflation run hot. Yeah. And keep in mind that at 2% on the 10-year, with inflation likely to be 2% or higher over the next several quarters, simply because the negative inflation prints last year after COVID hit in February, March, and April will drop out of the statistics. Even at 2% on the 10-year, the real yield is still going to be flat to negative. And so I don't think it's going to have any real effect on the economy. The Fed is going to be happy with a little bit of inflation. The markets will be surprised, and it will affect most significantly the tech sector. Because tech, as I wrote some months ago, rising rates and vaccines are kryptonite to technology stocks in the United States, because it ends the work from home phenomenon and it negatively affects the valuation of their cash flows. So to me, we have the impact on technology, which then impacts the US as a place to invest, given that tech is 40% of the market here in the US. And I think it also brings into bear the issue of Bitcoin and crypto assets and the potential for institutional investors to start to invest in crypto assets as a means to hedge against inflation. If in 2020, the retail investor drove the price of Bitcoin and cryptocurrency, In 2021 and 2022, it's going to be the institutional investor that drives the price of these assets. So I'll stop there. It's 7:52.
Yeah.
I know we have a couple of questions. They're both China related. So Ching, can you see the questions? Do you want to address? They're in the chat.
All right.
And maybe just.
Well, I don't really. Right.
I can read them to you if you want.
There's the quite strong sensors.
Yeah, Jacob, go on. Could you read it?
Sure. The first question, there's quite a strong consensus about the long-term prospects for China assets. What about the short and medium-term challenges, and how would they factor into your decision-making? Ching, do you want to go quickly first, and then Jacques, I think it'd be good for you to get an answer in there too.
Sure. We are very much long-term minded. You know, we look at China 5, 7, 10 years ahead instead of 5, 7, 10 quarters ahead. So for us, you know, what we pay particular attention to, it's really the quality of the growth of our portfolios, and also the long-term stability of that growth. Whether they deviate a little bit, a quarter, you know, 2 quarters, we're not so worried about. That's the best I can offer for people. And of course, you know, talk about challenge. I think the challenge is China, the government has done a very good job. You know, is this job too good? You know, we should be a bit careful when we become too complacent about the achievement we have achieved so far. You know, that's the challenge I see. You know, I'm not concerned about the growth. You know, I think if you look at China, even the short term, this 2021, the consensus are the China economy is going to grow 8%. I mean, that's coming out from a very low base. For me, whether it's 6%, 5%, or 8%, this number really does not matter that much. To me, what matters is the quality of the growth in China has changed so much in the past 3 years when you compare with the kind of growth we have seen in property-led and infrastructure-led. So the growth is much more solid, lot slower, but this kind of a growth that we like.
Awesome. That's a great way to end that comment, Ching. Jacques, your view?
Yeah, of course. You know, I'm not will be in the same line than Ching, because I'm agree with her about the quality of growth in China. It is better than in history, but we have to assess medium-term challenges, because plenty of clients now they have 1 year running assessment of their investments, or it's good for you, Ching, if you have client very patient about the 2, 5, 10 years, but mainly we have to assess even short risk in the blue sky scenario, because now we can be very happy perhaps with our current level of the indices. But if we had the same conversation in end of February of last year, we will not have this. We will have not the same faces. Okay, it was a catastrophe. All the asset allocation were disrupted, and after clients just had to print minus 25% or minus 20% in their strategies or assets. And now for me the main challenges on the short term, I'm seeing 3. it's how the Chinese financial sector will succeed to keep the trust of the international investors first. Second, it's how the state will manage the real estate. The real estate is kind of the collateral of the growth. We are seeing at the beginning of the year new rules try to curbing a little bit the loans for developers. Perhaps there is an issue there or not, but this is a odd point, I think, in terms of risk. On the last, it's a geopolitical one. It's how China will handle Taiwan on the China Sea. The China Sea is 1/3 of the entire trade channel, I should say. On Taiwan is a very hot topic. Americans are very nervous about Taiwan. And I don't know how China, it's a good question for Ching, about how they will handle Taiwan or not. But I think that it's perhaps also a short, medium risk to assess, on my view.
Yeah, I was thinking, and Ching, maybe to get your thoughts on this, and then we are going to go over just a couple minutes so that we can address our second question. But to me, Taiwan has become almost a no-go zone because of it's really become the dominant semiconductor producer in the world.
Yeah.
And therefore, no one can allow for it to be impeded. And I just wonder if that view, or what the view of Taiwan is, because I would agree that here in the U.S., the idea of China, and even overnight, there was talk in the U.S. about Chinese fighter jets patrolling over Taiwan. And I think this is like top of mind of people. But to me, the fact that the semiconductor industry is now basically centered in Taiwan makes it untouchable. Do you have any thoughts?
I'm not a politician, you know, and
that definitely not. Definitely not.
Yeah. So, sure. But I think the whole Taiwanese issue somehow might be overblown by the West, and you know.
I think that's probably right.
It's you know, for the past 20 years, you know, as a China equity manager, I can tell you it has been a interesting and frustrating experience, because every day I wake up, there's always a bad news in FT, in Bloomberg, in somewhere about China. There's always bad, you know.
Yeah.
And I think this, especially, you know, there's not a lot else to talk about in the past 6 months apart from Corona. But when you talk about Corona, I think China has done a relatively good job. Yes. So what can they talk about? It's Taiwan. I'm not saying that, you know, I don't care about this risk. For me, it confuses me, you know, the amount of attention that focused on one manufacturer, you know. Yes. And that is outblown. And we all know that China lacks the technology. The semiconductor is probably the most important part. We are away, depending on how many inches you're looking at. China is probably 2, 7, you know, 10 years away from the world advanced technology. And that's something I think we're not hiding it, we admitted it. And but I think the government has also said it repeatedly 10 years ago, 5 years ago, even 1 year ago. We Chinese, don't go out and kill the other Chinese. You have to understand, this is at our bottom line. You talk about war, what war?
Okay.
Technology war, we wait. We have time. We gained 4 years from Donald Trump. Well, we can wait another 40 years. We're not in a great hurry.
Clearly.
Great, Ching. Thank you so much for those thoughts. The last question, I'll read it, and then we'll go finish it quickly, and then we'll wrap up our webinar. But the last question, on China building trust with the rest of the world.
I saw that,
Chinese, yeah. Okay, well, we just read it for everyone. Chinese asset managers have little to no physical presence in the West. Therefore, Western investors tend to have China-related assets managed by Western asset management companies. When do you expect this to change? Ching, that question's probably directed to you. Should we announce that the three of us
I hope this will never change, because why a China manager needs to be based in the West? We need to be on the ground to understand our portfolio companies. We should never be based in the West. You know, the only reason that we are in the West is to sell our funds. And if our performance is good, clients would come. So I hope this good sort of habit will not change. And I hope, you know, with the development of the technology, the West can also take a look of a tiny, humble, little fund China manager like Redgate Asset Management.
Awesome. Redgate definitely deserves people's attention. Gate Advisory definitely deserves people's attention.
Lots of Gate.
W Advisory would welcome client and investor attention. I think with that little sales pitch, we will wrap up today's webinar, the great rotations of 2021. Thank you to Ching in Shanghai, where it's, I think, 11 o'clock at night. Thank you to Jacques, where he missed his lunch to be with us today. And thanks to Jay, who's not yet had breakfast here in New York. But it's been a wonderful hour. Katerina, thank you so much for your help.
Yeah.
Thank you.
Putting this together.
Thank you, everyone.
Do it again.
Great fun.
Yes.
Thank
Thank you
you
very much.